and welcome to Switzer Investing Insights, brought to you by NAB Trade. And today we really want to talk about the differences and similarities, I guess, of LICs, listed investment companies, and exchange-traded managed funds. Paul, it is an area of confusion for lots of investors, so that's why we want to talk about it today.
Yeah, it is, and let's probably just start with just how big this market is. There are more than 100 listed investment companies out in the marketplace. They range, Peter, from everything from the broad-based LICs, like, for example, Argo or AFIC or Milton Corporation, which have very broad-based share portfolios, through to very specialised and listed investment companies just investing perhaps in, say, some Asian investments. But there are more than 100 listed investment companies, and increasingly we have what are called exchange-traded managed funds, things like MGE from Magellan Global Equities. We've seen Platinum come out with some exchange-traded managed funds. That seems to be the new type of vehicle that lots of the managers are bringing to market. And each of these trade on the ASX.
So it's like an exchange-traded fund, but it's managed. So
Yep.
it's not passive, it's active.
It's like really like an ETF, but it has a manager managing the portfolio actively, and it's listed on the ASX.
So how do they differ then?
Well, look, LICs and exchange-traded managed funds essentially differ in three ways. First of all, a LIC is closed-ended versus an exchange-traded managed fund is open-ended. Secondly, in terms of the NTA or net tangible asset value, LICs can often trade at a substantial premium or discount, whereas an exchange-traded managed fund should trade pretty close to the underlying NTA. And thirdly, they have different structures and slightly different accounting treatment.
Okay, the open-ended, closed-ended, a lot of people might not understand that, so explain that, Paul.
Yeah, so with a listed investment company, it issues a finite number of shares and it has a finite pool of capital. It can only grow by issuing more shares. Okay, so it's what we call a close-ended structure. And you'll see a number of the listed investment companies have things like share purchase plans, and that's one of the ways they're doing that, of course, is it issues more shares and makes it a little bit bigger. With an exchange-traded managed fund, look, they employ a market maker who buys and sells units in the underlying fund. And the market maker does this on behalf of the actual fund itself. And in that way, the fund can actually grow if it ends up issuing more units, or contract if it's actually buying units back on the marketplace.
And that's why it's open-ended.
And that's why it's called an open-ended. So good exchange-traded managed funds are growing, and perhaps ones that are less successful tend to be contracting.
Okay, now a term you use a lot of people wouldn't understand is the market maker. So explain that.
Yeah, so what the market maker is essentially an ASX trading participant who's appointed by the responsible entity, the person who's managing the money, to actually buy or sell units on the ASX on their behalf. And what the market maker does is looks at the underlying net tangible asset value of the fund and works out where they're going to put bids on the marketplace and offers in the marketplace. And by making sure that those bids and offers are in a very narrow spread, that will ensure that where the units are actually trading on the ASX takes place very, very close to the NTA.
So effectively, a market maker looks at say for example, if there was 30 stocks in this exchange-traded managed fund, and the total value of them increasing was such that the unit price should reflect it, they make sure that the unit price that someone buys at is very close to what's happened to stock prices over the course of the day.
Absolutely. You got it spot on, Peter. And the fund actually helps that by publishing the NTA at the start of every business day, so the market maker and the public know what the fund is actually worth. And during the day, they publish what's called an indicative NTA or INAV. And so as the market moves up and down during the day, essentially the public and the market maker can see what it should be worth to take account of market movements. So everyone's informed about what the NTA should be at any point in time, and that's how we sort of get it trading at pretty close to what it is. Okay,
so why don't we talk about LICs, for example? They trade at a premium and a discount, which is not a big issue for exchange-traded managed funds because of the market maker.
Yeah, look, they could trade at a premium, they could trade at a discount. So
it wouldn't last all that long, really, unless it's extreme circumstances.
Let me just talk about why they do. So the reason that they can trade at a premium discount is because the company itself, the LIC, has nothing to do with where it's actually trading on the market. It's purely a matter of are there buyers and how keen are the buyers, and are there other investors who are sellers and how keen are they to sell. And so where the trade takes place really, depends just on the keenness of both parties. It has nothing to do with the company. Now, to help that, of course, the company does publish its NTA so people can get a guide as to what it should be. But as you can see on this chart in front of you, these premiums or discounts can last for a long period of time. So this is actually from Argo, of course, which is one of the biggest and largest listed investment companies. And this chart shows you its NTA and the premium or discount to the NTA over a period of more than 20 years. And you can see it's been at a premium as high as about 15% and a discount as low as about 10%. And those premiums or discounts have stayed there for a long, long time.
So in a sense, when it's at a discount, the market is being unfair on the fund because the value is a lot higher, but the market's saying, oh, no, we don't want to touch that. So
discounts are good buying, right? And when it's a premium, you'd say, well, why are you paying more for something it's actually really worth?
But can a discount be an early indication that there's something wrong with the fund?
Well, you've got to ask, as you said, Peter, why do things are they at a premium or discount? And one of the influence, of course, is market tone and direction. And sometimes markets can be very bullish or bearish, and that can affect just where the preparedness of investors to put more money in or to exit investments. And this is a generalisation, but more often than not, the better performing listed investment companies will tend to trade a bit more at a premium, and the weaker performing ones, in other words, ones not doing as well as their objective is, will tend to stay at a discount. Some of the smaller LICs will be at a discount too. So the market can be a hard market here.
I also would suspect that the calibre of the marketing of the fund manager can have a big impact on discount or premium
and the more communication that a listed investment company is having with its shareholders in the market, the more likely people are to come in and buy it. So look, marketing plays a role, performance plays a role, the manager, their reputation plays a role. I think what's really important for an investor is you really should look at the NTA and work out up front whether it's a premium or discount. And that'll have a big impact as whether you might invest in it.
Can someone easily work out the premium or discount?
Look, for most of the listed investment companies, yes, because they are required to publish their NTA at the end of every month. They've got 14 days to do that. The good ones get it out very quickly. Some publish it on a more regular basis. Some do every week. Some of the better LICs are actually doing daily. So it's getting better. Yeah. But and you can see you can get a measure how it's progressed during the month by just looking at what they invest in and looking at how the overall market has performed and making an adjustment. Of course, and the way we measure the premium or discount is of course to where it's trading on the ASX to what the NTA is, and that's how you calculate it.
Okay, one other difference revolves around the structure of these two funds and the accounting treatment.
Yeah, so a listed investment company, as it says, is a company, and whereas a exchange-traded managed fund is actually a trust structure. With a company, it actually pays tax directly and then distributes its net income and any franking credits through franked dividends back to the shareholders. The exchange-traded managed fund is really like a pass-through vehicle, so that all the tax benefits come to you directly as unit holders. Net effect is not a lot of difference, but what it means is the listed investment company can arguably perhaps smooth its dividends a bit more by withholding some and paying more in a subsequent period. With an exchange-traded managed fund, the distributions can be a bit more lumpy, and so you might need to make some adjustments there.
Well Paul, over the last few years, exchange-traded managed funds have become pretty popular compared to LICs. Is there a real reason for that?
Yeah, I think it's mainly to deal with this premium and discount issue with NTA, and I think, if anything, while there's new listed investment companies still being issued, the trend really is towards the exchange-traded managed funds.
Yeah, without a doubt. So that's Switzer Investing Insights, brought to you by NAB Trade. Thanks for joining us.